$180 billion hit the bond market in 72 hours. The Treasury didn't plan it this way. They had to. Auctions stacked on top of auctions, supply forced into a market that wasn't ready. Buyers who were supposed to rush in held back. Yields that were supposed to fall stayed elevated. And the moment the wave arrived, funding stress appeared. Not tomorrow, not in the data next week, immediately. The machine that's supposed to absorb unlimited U.S. government debt just stalled the moment it was pushed harder. And if you're waiting to see what happens next, you're already too late. It's happening now. The Treasury needed cash. That's where this starts. Government operations don't stop. Payrolls don't pause. Debt service doesn't wait. When bonds mature, they have to be refinanced. When deficits run, they have to be funded. And this week, everything came due at once. $180 billion in obligations that needed to be rolled over, replaced, extended into the future. So the Treasury scheduled the auctions, back to back, wave after wave, and they expected what always happens. Investors show up. Demand absorbs supply. Yields adjust smoothly. The system continues. Except the system didn't continue. It choked. This shouldn't be happening. U.S. Treasury bonds are supposed to be the easiest sell in global finance, the safest asset, the thing everyone wants to own. When America borrows, the world lends. That's been the rule for decades. The foundation the entire system is built on. Banks buy treasuries, foreign governments buy treasuries, pension funds buy them, insurance companies buy them, retail investors buy them. The demand is supposed to be automatic because the alternative, doubting U.S. creditworthiness, breaks everything. So the auctions always clear, the bonds always get sold, the Treasury always gets its money. But the auctions didn't clear cleanly. Demand looked thin. The bid-to-cover ratios that measure how many buyers show up for every dollar of bonds offered came in weak. Primary dealers, the banks required to bid in these auctions, had to absorb massive amounts of supply the market didn't want, and yields stayed high. Not catastrophically high, not crisis-level high, just stubbornly, persistently high. High enough to signal something fundamental has changed. High enough to show that the market isn't automatically accepting U.S. debt anymore. It's evaluating it, questioning it, and demanding to be paid more for the risk. The timing makes this worse. Markets were supposed to be calm right now. Easing signals were supposed to bring relief. Investors were supposed to be moving into duration, locking in long-term yields before they fall further. The narrative was set. The Treasury issues supply. The market absorbs it eagerly. Borrowing costs stay manageable. The system operates smoothly. But $180 billion arrived, and the market looked at it and said, "Not at these prices. Not at these yields. Not with this much supply hitting at once. You want us to take this debt? Prove to us it's worth it." This keeps happening. Every major issuance now comes with stress. Every auction reveals hesitation where there used to be hunger. The Treasury announces a wave of supply and yields tick up instead of down. Foreign buyers who used to take massive allocations are scaling back. Domestic buyers are demanding higher compensation. The automatic bid that used to exist, the reflexive demand for U.S. government debt, is eroding. And every time the Treasury pushes another wave into the market, that erosion accelerates. The numbers tell the story. $180 billion in 72 hours. That's not normal peacetime issuance. That's stress. That's the Treasury forced to fund itself at a pace that reveals how tight the constraints have become. And the market responded exactly how a market responds when it senses desperation. It held back. It waited. It demanded more. Because markets can smell fear, and the Treasury just showed fear. Not in words, not in press releases, in the sheer volume of debt it had to force into the system in a compressed window. And the market is extracting payment for absorbing it. This benefits someone. It always does. The primary dealers are positioned perfectly. They're required to bid in these auctions, required to step in when the market won't. And they're doing it, but they're immediately marking up the bonds and flipping them to the Fed or to other buyers who missed the auction. They're extracting a toll, a spread, a fee for providing liquidity the market refuses to provide organically, and that fee comes straight out of taxpayer pockets. Every basis point yields climb is more interest the government has to pay, more money going to debt service instead of spending, more fiscal pressure building in a system that's already strained. The large institutional investors saw this coming. They reduced duration weeks ago. They moved into cash. They shortened maturities. They positioned for exactly this scenario, where supply overwhelms demand and yields stay elevated even as policy tries to push them down. And now they're watching from the sidelines, waiting, calculating, deciding when yields are high enough to make buying attractive again. But not now. Not with $180 billion flooding the market and more supply queued right behind it. They'll come back in eventually, when the price is right, when compensation for risk is adequate, when the Treasury is desperate enough to make it worth their while. This hurts you, personally, right now. If you're paying taxes, more of your money is going to service government debt that just got more expensive to issue. If you're trying to get a mortgage, the Treasury just flooded the bond market and kept your borrowing costs elevated. If you're holding long-term bonds in any account, the Treasury just added supply that's pushing your asset values down. The issuance was supposed to be invisible, routine, background noise while the economy moves forward. Instead, it's creating stress that's rippling through every rate-sensitive corner of the system and landing directly on you. Here's how the mechanism is killing you. The government runs deficits, structural deficits that don't close. Those deficits have to be funded by issuing bonds. The more debt, the more bonds. The more bonds, the more supply. And basic economics says that more supply without more demand means lower prices and higher yields. Higher yields mean higher interest rates. Higher interest rates mean higher costs for everyone who borrows. Home buyers, businesses, the government itself. So when the Treasury dumps $180 billion into the market in 72 hours, it's not just a government finance operation. It's a tightening mechanism that affects every single borrower in the economy, including you. The market depth has disappeared. That's the real crisis. The Treasury used to be able to issue unlimited supply, and the market would absorb it without a ripple. Foreign central banks would take down massive chunks, sovereign wealth funds would participate heavily, domestic institutional buyers would show up reliably. The bid was automatic, the depth was real. But that depth is gone. China is reducing Treasury holdings, Japan is selling to support the yen, Middle Eastern buyers are diversifying, and domestic buyers are cautious, skeptical, demanding higher yields before they commit capital. So every auction becomes a test, every wave of supply becomes a stress point, and $180 billion in 72 hours just showed how little depth is left. The dealers are drowning. They're required to bid, required to support these auctions by their agreements with the Federal Reserve. So they step in, they absorb what the market rejects, and then they're stuck holding inventory they don't want, stuck with balance sheets bloated with Treasury bonds that are losing value as yields drift higher, stuck hoping they can offload this debt before the next wave arrives and makes their positions worse. They're the shock absorbers, the last line of defense between smooth auctions and failed auctions, and they're getting crushed under the weight of supply they're forced to carry. This won't stop. The government can't stop borrowing. Revenue doesn't cover spending, not even close. The deficits are structural, built into the budget, locked in by mandatory spending and insufficient taxes. So the Treasury has to keep issuing. Next week there's another auction. Next month there's another wave. Every quarter, every year, more supply. The $180 billion this week isn't the peak. It's the new normal. And a market that's already struggling to absorb it has to keep absorbing. Week after week, month after month, until something breaks. The yields are telling you what the press releases won't. They're staying elevated because the market has lost confidence in the Treasury's ability to keep borrowing at this scale without consequences. They're elevated because investors want more compensation for holding long-term U.S. debt. They're elevated because the automatic, unquestioned demand that used to exist is evaporating. And every auction that clears with weak demand and high yields makes the next auction harder, makes the next wave of supply more difficult to place, makes the entire debt structure more fragile. The next 48 hours decide everything. More auctions are scheduled, more supply is hitting the market. Billions more in government debt being offered to investors who just watched the last wave struggle. And those investors are making calculations right now. Do yields justify the risk? Is the supply going to keep overwhelming demand? Is the Treasury losing control? Every participant is watching. Every buyer is hesitating. Every dealer is praying they don't have to absorb even more. And the Treasury is committed. The auctions are scheduled. The debt has to be sold. There's no backing out now. If demand stays weak, yields spike. If yields spike, everything connected to Treasury rates reprices. Mortgages reprice, corporate bonds reprice, municipal bonds reprice. The entire rate structure of the U.S. economy adjusts to reflect the new reality that U.S. government debt isn't the unlimited safe haven it used to be. And that repricing is violent. Not gradual, not smooth, violent. Because markets that lose confidence move fast. If yields spike and demand breaks, the Fed has to intervene. It has to step in and buy the debt itself. It has to print money to absorb what the market won't. And that's the endgame. That's fiscal dominance. That's the moment the central bank admits it's not independent anymore. That it exists to fund the government. That monetary policy is subordinate to fiscal needs. And the moment that becomes explicit, every assumption about dollar stability, inflation expectations, and U.S. creditworthiness gets reevaluated. Globally. Immediately. This looks like the moment the debt market stopped obeying and started pushing back. Not loudly, not with headlines. Just in the auction results. In yields that won't fall. In demand that won't show up. In primary dealers absorbing supply the market rejects. In a system that used to operate automatically, now operating with visible friction, stress, and strain. The Treasury issued $180 billion and expected the market to take it like it always has. The market took it, but reluctantly, skeptically, and at a price the Treasury didn't want to pay. You're watching the Treasury lose its ability to borrow without limit. Not in one dramatic moment, not with a failed auction that makes front-page news, just gradually. $180 billion at a time, auction by auction. The market is imposing discipline that politics never would. It's saying, you can borrow, but it's going to cost you more. You can issue, but we're not buying at yesterday's prices. You can flood the market, but yields are going higher. And every time yields go higher, the debt burden grows heavier. The interest payments grow larger. The fiscal situation deteriorates. And the next wave of supply becomes even harder to place. The funding stress appeared the moment the wave hit. Within hours of the auction's closing, the stress was visible. Yields elevated across the curve, spreads widening in credit markets, liquidity thinning in secondary trading, other parts of the bond market repricing to reflect the new reality. Corporate borrowers adjusting their plans because Treasury yields stayed high, municipal issuers delaying offerings because the benchmark moved against them. Mortgage lenders keeping rates elevated because the underlying Treasury curve didn't cooperate. Everything connected to U.S. government debt repricing in real time to reflect the fact that the foundation just shifted. The Treasury thought they could force $180 billion into the market in 72 hours, and it would just get absorbed. Like it always has. Like it's supposed to. But the market just showed them something different. Showed them resistance. Showed them hesitation. Showed them that there are limits. Not theoretical limits, not limits that apply in some future crisis. Limits that exist right now. Limits that showed up in this week's auction results. Limits that manifested in yields staying high when they were supposed to fall. Limits that appeared in demand looking thin when it was supposed to be robust. You're holding assets in an economy where the government just discovered it can't borrow unlimited amounts whenever it wants anymore. Where $180 billion in 72 hours causes visible stress. Where the market is questioning, evaluating, demanding to be paid more instead of just accepting whatever the Treasury offers. And you're positioned as if none of this matters. As if the auctions will always clear smoothly. As if U.S. debt capacity is infinite. As if the next wave of supply will be absorbed just like all the previous waves. The next auction is coming. More supply is hitting the system. And the dealers who just absorbed inventory they don't want have to absorb more. The foreign buyers who stayed away last time have to decide whether to come back. The domestic investors who demanded higher yields have to decide if yields are high enough now. Every participant is watching the others, waiting for someone to blink, waiting for the auction that finally fails. And the Treasury is pushing forward, because it has no choice. The government needs cash. The debt needs to be refinanced. The machine has to keep running. But machines that run under stress break. Not all at once. Not predictably. They break when one component fails under pressure, when one auction doesn't clear, when one buyer that always showed up doesn't, when yields spike so high that something else in the system snaps, a leveraged fund, a pension portfolio, a bank balance sheet. Something that was designed for yields at one level breaks when yields go to another level. And the stress from that break cascades, spreads, multiplies. The debt flood is exposing the cracks. The cracks policymakers insisted didn't exist. The cracks that analysts said were impossible. The cracks that the entire global financial system is built on top of. And those cracks are widening, one auction at a time, $180 billion at a time. The Treasury is testing the market's capacity, and the market is showing its limits, not by refusing to buy, by demanding to be paid more, by making it expensive, by making it stressful, by making it clear that the next wave will be even harder than this one. You're watching the Treasury lose control in real time. Control over borrowing costs, control over market conditions, control over the narrative that U.S. debt is the safest, most liquid, most demanded asset in the world. That narrative just took $180 billion worth of damage, and the next 48 hours will show whether that damage is containable or whether it's about to spread across every corner of the system that depends on stable Treasury markets to function. Your mortgage depends on it. Your bonds depend on it. Your tax burden depends on it. Your entire financial position depends on the Treasury being able to keep issuing debt without breaking the market. And this week showed you how close that market is to breaking. You're watching the Treasury lose control in real time. Control over borrowing costs. Control over market conditions. Control over the narrative that U.S. debt is the safest, most liquid, most demanded asset in the world. That narrative just took $180 billion worth of damage. And the next 48 hours will show whether that damage is containable or whether it's about to spread across every corner of the system that depends on stable Treasury markets to function. Your mortgage depends on it. Your bonds depend on it. Your tax burden depends on it. Your entire financial position depends on the Treasury being able to keep issuing debt without breaking the market. And this week showed you how close that market is to breaking.